Looking back at the charts now, I mean, going into the non-farm payroll, I mean, what's going to happen if we see a good non-farm payroll? Then you'd expect, a further downside in the pound. You'd expect the dollar to strengthen, therefore the euro to come off, the pound to come off. And the reason for that is the strong non-farm payroll was not just positive for the US economy, bringing demand in for the pound, but it really puts Janet Yellen into a corner to say, right, well, you've told us potentially 4 rate hikes this year, and now we've got time for probably one. So we're looking at 168,000 for the non-farm payroll today. So quite a tight range today. 155 on the low, 200 on the high side. So anything I would say above 160, essentially anything kind of fairly in line, means that a rate hike is on the cards in November. I would say early November, and then the Fed has kept to its policy. We're going to have a new president. And then who knows what's going to happen? The dollar might fall off a cliff if Trump gets in. But in the short term, while we're talking about economics and we're talking about the relationship between data and being data dependent and rate hikes, this is as clear cut as it gets. If we see a strong non-farm payroll, Janet Yellen has nowhere to hide, and she really has to now think about putting that 25% basis hike in, which is really what should be happening anyway. So before the non-farm payroll, we're seeing the opposite. We're seeing obviously these big spikes in the pound. We have to really just make that about Brexit and about the pound itself. But we're weakening against the yen. The euro's at highs against the dollar. S&P not really doing anything, but again, Sam was saying about the FTSE and new highs, etc. FTSE's been very comfortable. The S&P's been very comfortable above 2,000. And as I said, I can't keep repeating myself, but I mean, look at the charts. Every time we've hit lows and rejected, we've gone higher. I mean, look at this. This is essentially just quantitative easing and big hedge funds having no other choice but to keep buying stocks. And when it corrects, as I said, we'll correct. We'll finally break these kind of levels below 1830, and then that'll be resistance, and we'll get down here. And I can easily see in the next kind of coming years that we'll kind of bounce between maybe 1400 and 1800, and that'll be the new norm. Because once the institutions, the big boys, take the money out, that's never coming back, or well, not coming back till much later in the future in charts. And again, that will correlate with interest rates. Stocks are still a very risky investment. If you look at a balanced portfolio, stocks are only meant to be, maybe 10% of your portfolio. I'm guaranteeing, a lot of the big boys, a lot of average punters and investors are much highly weighted than that. And when interest rates get above 1%, which they invariably will, inevitably will, they finally start to normalise, people pull the money out of risky investments, put it back in cash. That's just the way the world works. It's simple. So right now, every time the markets have sold off, yeah, of course, history tells us we buy the dips, and it keeps going up. And that's the same. You can look at the DAX. You can look at the FTSE, they're all pretty much exactly the same. You bring up the FTSE, the DAX, and again, every time we've hit these low points, really, really kind of simple. I mean, how simple is a chart going to get? You just buy these low points here, and the market continues to go up. And I don't know, I can't make it any simpler than that, can I really? It's going to sell back up, and it probably bounce, and when it crashes, it'll crash, and you'll see a move like you saw in the pound dollar in cable. You will see the markets hit new lows and not retrace, and it will come. I mean, I think a lot of people have been caught, off guard. I mean, burnt that, stocks are high. There's all these arguments that, stocks shouldn't be high, and, they shouldn't be high for this reason, for that reason. But you can't really argue with the past. Every time we've seen significant sell-offs, then the market has bounced back up. And until, I think it will correlate with interest rates more than anything else, more than, I think the only other thing that might trigger it is another, not credit crunch. I think it'll be different this time around. It'll be something else, but it'll be something to do with personal borrowing, or it'll be something to do with an investment bank that just again has broke the rules, broke the laws, and someone's going to go under this time. There won't be this too big to fail mentality. Another big investment house is due for a spanking, and it could be as big as Deutsche Bank, or it could be as little as, I don't know, somebody else. Just name any other, well-known bank. And if it isn't that, then it will be something to do with personal debt, which is obviously linked to the housing bubble, which is also linked to interest rates. So I think, invariably there might be the perfect storm brewing, where a lot of people have been able to exist on cheap borrowing, have overestimated how much the equity in the house is going to be worth. They've been living beyond their means for since the 2007 credit crunch, and maybe if we get to, I don't know, 0.75% in the UK for interest rates, maybe that's the perfect storm, and personal, kind of credit cards just destroy people, mortgage things destroy people, and that's when we see, a major, correlation stock correction because people have to liquidate assets. Maybe, the boomers are bailing out millennials that have bought overpriced houses with money they didn't really afford or have and never really earned. So anything. But what we've learned is that every 7 years there's some sort of correction in the markets or downturn, and we've kind of dodged that because of the extraordinary measures we've taken, the quantitative easing, the low interest rates, etc., etc., etc. But you can't put things off forever. I mean, the top 1, 5, 10% won't be affected as always. It'll be everybody else. But there'll be something that happens and it is attributed for the stock correction. And I don't know exactly what it will be, but I assume it will be around personal debt. And that's what's going to drag everyone down. So again, in the stocks, positive non-farm payroll, you might see a spike up quickly and then an aggressive sell-off because, again, it's not technically bad news. It's technically bad news because it's the implications on interest rates, isn't it? So, a strong or inline non-farm payroll could send the markets up and then closing down lower because of that assumption that interest rates are going to go up. So, I mean, really, in the markets, I don't see any massive opportunity before the non-farm payroll comes out. I never go long or short into the non-farm payroll. What's the point? You're expecting good data at 1:30, so you wait for it. You can try and pick out a bit of a trend beforehand. Not really served me. The ADP was fairly much in line, so that seemed to be a precursor sometimes to non-farm payroll. So right now, I would say if we see a very strong non-farm payroll, then you see gold getting hit heavily. You see the stock spike up and then get sold off, and maybe that's just a new license for everybody to pile in and sell below the 50% in cable. So from my perspective, all in line, good news, bad news, whatever, really everything to sell. Because unless it's like a minus figure, everything for me is pointing to dump some stocks and to dump some pound and euro from the highs. So for me, that's the way I'd be looking at it. But again, as I say, I try to go into these things fairly neutral. I don't care myself. It's good news, bad news. We just trade what the market's showing us, and we trade a product that looks to be moving, and that's how you make money in fundamental trading, by trading what is moving, what's giving you the opportunities. All right, guys. Any thoughts? Any questions? Again, I'm not trying to be overly blunt, but I'm just trying to tell you the way it is. It's I don't ever sugarcoat trading. I got to where I am by being a good trader. It's like the educational side of it and the kind of commentating side is an ego thing. I do it because who wouldn't do it? So any questions, Simon?
Hi, Steve. Yeah, Anise says without going back to the long-term trend trading versus intraday. Without intraday trading, there won't be a day candle or a week or monthly candle which creates a long-term trend. So that's a good point.
That's insightful, yeah. No, well, I mean, there won't be an hourly candle without 15-minute candles. There wouldn't be an hourly candle without a 5-minute candle, a minute candle. Don't have to use them. I mean, a daily candle is important because a day closes. Hours, generally close, but they're part of a day. So I start my technical analysis based upon the monthlies, weeklies, dailies, and then everything else is open to movement, open to interpretation. So that's the whole point of trading. When you see my charts, these lines, that you see, the dotted lines are D1, daily, week 1, W1, monthly, M1. So I'm fully aware of the longer term trend. I'm fully aware of where the markets have been, where they can go. I'm fully aware of everything. That's why I'm a successful trader, because I know everything. And that's what you have to do. But the money's to be made when it's actually moving and it's unknown. That's the whole point. The unknown quantity and the unknown, again, I mean, you could have been short into that cable move in that hourly candle, but that didn't close towards the bottom. You could have seen your account 10 grand on side. Then by the time you've blinked, you're back to 2-3 grand on side. I mean, this is where the money's there to be made, in the short term, in the unknown. Of course, you can follow a trend and make money. I'm not saying you can't. That's absolutely how the world exists. But from my perspective, if you want to take less risk and you want to make more money, then it's an intraday trading. It's simple. Unless you've got millions and billions to invest, it's.
Yeah. Listen, you've traded these non-farm events and the other events as well for a long time. How many times do you get an upset then? Because everybody's saying, well, it's going to be 170,000 new jobs added, or 168, or whatever. Okay, so that's already priced in. But is it that you're waiting for a surprise, or how often will a surprise come and catch everybody or wrong foot everybody in your?
The thing is, it's not like that anymore because it's too complicated. It's not that you get surprised by an over, inflated figure. I've seen it probably, it happens twice a year, really, on average, that the market gets it wrong. But again, it's only longer term investors that are wrong for that short period of time. It will correct, it will, kind of, be faded out. So it's only people in the short term that are trading just before the figure that are caught out by wrong things. And not many people do that. At the end of the day, I mean, the figure is the figure. You have to remember that people will be using this non-farm payroll as an opportunity to trade all styles of trading. It's not necessarily fastest finger first, and it's a high figure. You buy it, you make your 25 ticks in 30 seconds, and job done. It's not really how it works anymore. It's
Yeah. Okay. Vidas is saying, okay, in the scenario short term for the euro dollar movement in the case of 160 plus on the NFP. What what do you think is going to happen to the euro dollar?
well, I've said already. I mean, it's basically it looks like a sell for everything for me. It's a sell for gold, it's a sell for
Yeah.
high in the stock, sell for the euro, sell for the pound, because you know, if it's in line or it's good or it's, it'd have to be, in my opinion, below 100 for it really to have any effect on Janet Yellen's, decision to change rates. So, unless we're going to suddenly break with, this uptrend in non-farm payrolls massively, then
Hmm.
anything really kind of 160, 150, 140, it's still not terrible data. It's still job creation. It's still 140,000 jobs created in a month. It's still big. So for me, I don't see, unless it's sub 100, I don't see any scenario where it isn't a good figure.
Gordon says numbers are good and the euro drops. Will that mean that the DAX, the FTSE, and the European markets should rise?
Well, I mean, if you're going off the previous correlations, as the pound gets relatively cheaper, then yeah, you're seeing the FTSE rise, because you buy the FTSE in pounds. But these kind of correlations, they're not traditional correlations for me, to be honest. If I'm looking at correlations, I'm going off coefficients in currencies. I'm not necessarily linking movements in stock markets to the underlying, what it's priced in, personally. But yeah, I mean that's been a current trend. So you could see if the pound drops, the FTSE does over spike. But then again, the FTSE will tend to follow the S&P. So if we do see a spike in the stocks and it looks like Janet Yellen will put interest rates up based upon a good, strong non-farm payrolls, then you're going to see people selling into that over the weekend because higher interest rates are bad, in traditional economic terms. Well, not bad, but worse for business. So whatever, guys.
So
I can't give you all the answers. I can tell you all the scenarios that could happen. What I'll be doing is I'll be watching for that first 5 minute spike. I'll be seeing what markets are moving. I'll be basing my trade on the correlated markets and what the actual figure is. And as I say, if the FTSE spikes above 7,100, I'll probably be selling it
Mm.
because I think that's too high. But then that's I'm not about being right. I'm about making money.
David says, every time I consider changing my trading approach to a bit longer term, something like last night's crash reminds me why I stick to intraday. There we are. Gordon says,
Exactly
can
right. I
Steve
mean,
go?
that's the thing. I mean, it can be an opportunity, but to make money in intraday trade. But it can also be, when you're a longer term trade. If you put your trade on yesterday long, then you're smashed out. You're done, finished. For what? For a flash crash. This is the problem with longer term trading. Unless you're truly longer term trading, I'm talking weeks, months. Think about traditional portfolios. When I was back at PwC flogging balanced portfolios, you put your money with me. 10 years you're looking at the FTSE. People can't stand 10 days in the market, let alone 10 years these days. So longer term investing is not all it's cracked up to be. The world's changed. And that's what people don't get. The pace of change is too quick for people to get to grips and understand it. So
Mhm.
again, there we go.
Do you have time to show us the FTSE current fib levels and make a comment on them, please?
Yeah, I mean the kind of intraday stuff, looking a little bit bearish, I would say. I mean, from the hourlies, we've peaked up to make these new highs. 171 to 25. We've hit that 50% and not really kind of made much of an attempt to make them fresh highs. So really, if we get below these low levels here at just below 7, excuse me, 7,000 at 6,994. Um, yeah, I mean, the FTSE, a bit of buoyancy based upon Theresa May and based upon the low pound. That's not enough to keep it. The basic underlying factor of the FTSE for me is the thing that shocks and concerns me the most is around about 71p of every pound made by a FTSE company is paid out in dividends. So we're woefully underfunded in the FTSE 100, and we're just another bubble in the making. So when it corrects, it will just move a lot quicker, and that will fuel the move. And it's idiot. No, idiot's the wrong word. Too strong. It's inexperienced investors. It's retired teachers. It's dentists. A lot of these are my clients. People that don't really, truly, if they're honest with themselves, understand the markets, getting involved in a trend that people have seen and making good money, but they're not prepared for the downside that's associated with making money. And if you're caught long the FTSE or any kind of stock market, when it corrects, you're going to get burned. And that's what I see happening for a lot of people out there. So realistically, in the short term, I think 7,000, we've never been comfortable with 7,000. I don't see any reason why we should be above 7,000 in the UK with the fundamentals, the Brexit, etc., etc. We're going to have to take some pain at some point. So I think the lower levels are much more likely. And I've just done a Reuters poll actually, that's just been released today, and I'm talking Q1 next year. We're probably at 6,700. Round about there, fairly stable, but then after Brexit's triggered, within 2 or 3 months, we're down at 550 in the FTSE. So that's how much I'm expected to drop over the next, 6 to 9 months.
Okay.
1,500 points easy, and that could happen. That could happen in a week. It's
Okay.
happened before. It'll happen again.
Everything goes up and then comes down. Okay. You
That's
heard
it,
it
mate.
here.
It's all about timing. Trading's not about being right. It's about being right at the right time.
Right time. Well said. Okay, Steve, thank you for that. I know you've got another webinar starting shortly. And he says
Yes.
black swans will exist. The smart way will be look for trending instruments and get on it intraday. So you make
Yeah.
use of the trend and avoid as much as possible the flash crashes. Okay,
I
well said.
do. Yeah, I agree with that completely. Yeah.
Fantastic. Well, Steve, I think we'll let you go because I know you've got everybody wanting your time today. So thank you for joining us, and thank you for joining us all week. In fact, you've given
It's my
us a
pleasure.
daily update every day, which has been great. So appreciate that, and I will book you in for that pint and a pie at some point. Say
You're too
thank you
generous,
on
Simon. You're
behalf
too
of us
generous.
all. Just before we go, everybody, if you do want to get in touch with Steve, I know he's taking on some mentoring positions. The way to do that is go through his website MT4 Switch, which I'm just putting in the box there. That's the best place to get in touch with Steve. Get onto one of his programs, and you can be trading intraday as well. So Steve Ruffley, MT4 Switch, InterTrader. Thank you very much indeed. I'll take the presenter role back.
No worries. Cheers, guys. See you later. Good luck for non-farm payrolls.
Cheers, and you. So there we are, a little update from Steve on what we are going to do, given the non-farm payroll, if you're trading that. So we are taking a break now. It's 12:35. We'll be starting again with Zach Muir at 2 p.m. So we'll be able to see what's happened at that point. But of course, Zach is going to be focusing more on stocks. We're going to look at the stock market, what's happened this week, and what might be happening in the weeks and months to come. So if you're in any stocks and you'd like Zach to analyze them, look at the codes, the company names, and he will give you a live update on that at 2 p.m. So look forward to seeing you again there for the last presentation. Many thanks. Okay, well, welcome back everybody to the afternoon session for London Investment Week Live. My name's Simon Campbell. Thank you for joining us, and we are just a few minutes away from welcoming Zach Meir to join us at 2 p.m. for a look at the stock markets, what's been going up and what's been going down, and analysis of some of the companies, the main movers. Just before we go across to Zach, he's perhaps most well known currently for his programs at Tip TV, which is the internet investing channel. And I've got that on the screen here in case any of you have not come across tiptv.co.uk. It's a very good source of information on a daily basis. So if you have a look down, website's very good. Daily videos are posted there with all the dates and the titles. And so you can go, there's Zach there, who's just about to speak, and lots of historic recordings there for investors. So huge source of information for you there. tiptv.co.uk is where to go, and if you're interested in investing, of course, as well, please be aware that the London Investor Show takes place next week, and this time next week, Friday the 14th of October, in the Royal Horticultural Halls, and there will be many, many speakers attending and having seminars and workshops, debates and panels and all that sort of stuff. So go to londoninvestorshow.co.uk and you'll be able to apply for your ticket there to the show. So lots going on in the markets, and hasn't been a better time to have an event like this with all the goings on, and we're very pleased that Zach's here, shed some light on it for us and give us the benefit of his insight into what might be going on as we move into next week and next month, what's going to affect the stocks that we're trading. So this is an opportunity as well for you to suggest for Zach to have a look at any stocks that you might be trading at the moment and to see what he's thinking about them. So please use the chat box to sign in and ask me what companies to put for to Zach. Joaquin, sorry, just a wee bit faster. London Investor Show .co.uk. I will type that in. There we are. LondonInvestorShow.co.uk. Okay, I'll be there myself this time next week, so looking forward to attending that. Always good at lots of interesting things going on there. So let's turn our attention to today's markets, and we will see if we can bring Zach into the webinar right now and have a chat. Good afternoon, Zach. Are you there?
Good afternoon, Simon. I'll be appearing in the bar at the London Investor Show.
Well, if you turn round, you might see me right next to you.
I'm very good in those roles.
Fantastic. We're looking for it. It's always a great event. Of course, I have a connection to the London Investor Show. Of course, my sister is the organizer, so I'm obligated to attend. So I'll be there to attend that. I know she's extremely busy at this point in the weeks leading up to it, so all be good fun. So Zach, you must be in demand, I'm guessing right now with all the goings on in the markets.
Well, I've just started writing for Yahoo Finance, so I've just finished my weekly article for them, which I'm very proud to be on that stage. And then I also do a podcast for City AM, so that's my full. That with Tip TV are my full duties in life at the moment.
Wow.
So, I suppose it's nice to get your stuff read, and it's nice to hopefully now and again get it right, and lap of honour and everything. But I think actually for me, I'd like to start off with pound dollar, which I don't know if you can see. I don't know if you
Let
can
me
see my
go.
screen.
We haven't gone
Can you
over
see
it
it?
yet, so we're just doing that now. If you should, you'll get a button inviting you to share your screen now. So
I don't know if you can see that, but
yeah,
that
that's great.
that channel has been there, and I drew that like I don't know when it was a week or two ago, as the best guess of where this was going. And obviously last night it hit it in just in one go, if you see what I mean.
Mm.
Um, my view is that on this, I think somebody's in there selling the pound aggressively. I don't think it was a fat finger, and I think it's one of those situations where it's a bit like the George Soros thing in the 90s, and also when there was a battle with the Bank of Japan and the yen. You
Hmm.
tended to get speculators sort of like a dawn raid or a midnight ambush you'd get, and they basically hit the currency when the market's quiet, and therefore there won't be the bank intervening to protect it, if you see what I mean. So I
Wow.
think this is, this is going to be quite a serious problem here because with the policies that they have of Carney and Fred, well, basically it's Carney, but the zero interest rate thing is a disaster because it just tells people there's no reason to be long of sterling,
There's no good news on
and
the horizon.
that
Well, I
last
think that.
move,
Mhm.
sorry.
That echoes what we've been hearing from other speakers all week. In fact, of course, they didn't realise what was going to happen last night. So you're of the opinion that this might be some sort of manipulation of the markets with that?
Well, no, I think no. I just think it's a if you're a hedge fund, I mean, it's an easy trade to do.
Mm.
It's as easy, it's just there's rarely times when things are 90% plus as far as probability concerned, and this I think is one of them. And the only thing is whether I would guess that the Bank of England is probably having to do something in the markets already. These things always emerge a few weeks afterwards, but I think that that if there's not that situation, it'll happen soon. And it brings me to probably, as this is a stock market focused thing, it brings me to EasyJet, where the chart for me is very, very similar to what we saw or what we're seeing on pound dollar, almost like it's very, I mean, it's very, very closely aligned.
Mhm.
And basically, this is the proxy for sterling weakness. So if you would go short or remain short of EasyJet on that basis, the gap down earlier this week really says it all as far as the price action, and we've got even today had an attempt to rally, and then we're near the lows of the day now. So technically, a very very negative picture there.
So they get hurt, obviously, but they're very exposed
Yeah, I
to
mean
the
they were
vagaries
already
of
yeah,
currency.
they were already saying they're losing 90 million pounds on on currency losses. But I think the other problem is obviously even though people might be flying in from Spain and France over here,
Mm.
the business of people going over, you're really not in the mood to go to Europe, or at least with the sharp depreciation of sterling. Holidays are very very expensive now.
Mhm.
So I think that's a
Okay.
stock to keep. That's a stock to keep looking at if you're, on the bear tack and looking for gains in that direction. On the upside, we still have the dollar earners, especially the oil companies, which I think have been helped by the rise of crude oil through the $50 a barrel level. Russia trying to also tighten the price and tighten supply. Presumably, well, already doing its activities in Syria, but other ways of tightening the supply as well with OPEC. And really, the main hope for the FTSE now, I mean, obviously we broke through 7,000. I'll look at the FTSE in a minute. We broke through 7,000. Is that the horror of weakening sterling will at least help the dollar earners in the FTSE 100. I think BP is probably the most viable in the sense that it's generally a slower mover, not so volatile. So even if you go in a bit late, you shouldn't have too rough a ride on the stock. It looks as though it's going to 520, which is the top of this trend channel, and as long as we remain above that old peak, the old resistance area 464 in July, I think we should head up to 520 quite quickly. That probably gives the FTSE 100 a target around 7,200 at least, just on BP alone. And obviously after that we can see or judge how strong the rally is there. I think the only problem is if the decline in sterling, is really, really quick. If we get down to between 110 and 120, that might start to erode confidence in UK stocks, because obviously you don't particularly want to be rushing into a country where the currency is declining faster than the assets that you're buying into are rising. So for the FTSE, 6940 was the old September peak, and I'm looking for best case scenario target here at 7400, but I can't really see it going much beyond that level, even with the weakening sterling and dollar earners going up, just because I think there will be some uncertainty. There will be fretting over the monetary policy here, which I think has reached something of a cul-de-sac, let's say.
You mentioned the BP price there, Zach. Andy's just asking, what did you say about BP? I think you might be.
Well, no, I just think that the BP is also in favour at the moment as well. While I remember, is because I think next month it pays out its dividend, so we are in the run up to I think the yield is well over 5%. So there will be dividend buying in BP over the next few weeks, and same with Shell as well. So that will be very supportive of the FTSE 100 and leading stocks.
I mean, this is fairly unprecedented times for the stock markets to be having such a big influence by the forex currencies. It's quite unusual. I certainly don't recall over the last.
Yeah, I think it's unusual. It's unusual because the last time there was, I suppose the last time was 1992, but I don't think at that time there were so many dollar earners in the FTSE 100. And I think in the last 10 years, since the miners came in, that made it a much more dollar earner type of index, and obviously not really reflective of the UK economy. It's probably worth looking at the FTSE 250. If I can remember the code, which I think I have, yes. The FTSE 250, where there has been a break to the upside, but not quite in such a dramatic way. Although, as we said, that doesn't seem to be. I think if that's the right code, that doesn't seem to be that far behind where the FTSE 100 is. So
this is mainly made up of UK companies that are earning
UK companies. Yes, but I mean, I think the UK companies. It's very much sector based. You've got the banks still, let's say in crisis, and that's the problem, that they're still in crisis. But you've got supermarkets who might do better because of rising inflation expectations, and the house builders maybe fretting over the Brexit and less foreign buyers to buy into them. So but that makes it very, very complicated, I think, to try and work out what will be the winning and losing, what will win and lose overall, or what the overall picture will be on that. I mean,
so would you advise people, if you're in long-term positions now, is there anything that you think people should be starting to take note, take cover, hedge, anything like that, or?
Well, I think the problem is, in theory, with the sterling falling, the FTSE should keep on rising. I would have thought as we head towards 7,200, and even if we get towards 7,400, then you would have to be lightening the load. The other problem, obviously, is we're a month away from the US presidential election, which I think is a bit like the Brexit situation, where the market is expecting Clinton to win, and therefore is squeezing higher. And the problem with that is that you might. It's fine being long until that time, but then if there's a surprise, then you can't get out. So you've got to be lightening the load to some extent, I would say, ahead of time.
Okay, I've just received a question. Saying that the screen isn't central, but I can't see the hours on the business end. Are we missing part of the chart? I don't think we are. I think
Let
we
me
seem to
try
be.
and does that help?
No, it's just the same. I think if you maximize it.
Let me try and that might help. This might help. You got charts of RBS there?
So this, yes. What about legal in general? Getting a question about legal in general. I think everybody else is actually saying it looks fine. Can you put it back to how it was before? I think
Right. Okay.
I think it was.
Right.
Gordon,
Okay. Right. So
I think it might
basically,
be you,
here, I mean,
Gordon. Mm-hmm. Let's put it
yeah,
back
it's
to.
a similar position. I mean, a similar position to on many financials, just approaching the 200-day moving average, and that's the black line there around 221. You've got a resistance line there up to about 225 as well. So this is really the sort of the key, the key area. You've had a decent run since the Brexit vote. I would be taking some of this off the table at this area, and then hoping that the stock will then continue up to the main 240, 250 zone. The RSI reading, which I use to help me on these matters, is positive in the sense that one would be looking for a breakout because the RSI is over neutral 50, it's at 58, so that should be a leading indicator on the upside, and also we're still above the 50-day moving average, the blue line there, at 213. So above 213, I'd be looking for a break to the upside, and 240, 250 on legal in general.
So this is the typical setup that you would use with these moving averages set up
Yes,
in
I
the
mean, I think one of the lessons is to do well, whether it's the best thing or not. To be, I mean, I've been looking at the same things now for like 20 years, something like that. And I think a lot of people, their mistake in technical analysis is to change and chop indicators and moving averages and come up with the 110 exponential moving average and all sorts of other stuff like that, or stochastics or MACD. But the main value of this is to approach everything in the same way every time, so that you gradually improve on your experience of the markets, and you're comparing like for like. So in this situation, with the RSI above 50 and the shares above the 50-day moving average, I'm banking on a break to the upside here. If it was Barclays, which I think is a very similar chart from memory, would you can see there just hanging around the 200-day moving average, exactly, almost identical actually. RSI also 58. So I'm looking for progress. I mean, you know, you've got a line of resistance from earlier this year, but I'm expecting this to break through 175 and head towards the 190 level while we hold above 165. So it's just a matter of creating a template where you're consistent in what you do, and you therefore enjoy the benefits of risk reward and statistics. So here, for instance, I'm risking 7p to make 18p, and that's a reasonable risk reward, and hopefully with the shares above the 50-day average and the RSI above 50, that will come through.
Wayne is a regular viewer of your Tip TV show, and he says he's noticed that you have Francis Hunt on, of course. Francis talked on Round the Clock Trader a few times as well. Francis believes that Deutsche Bank is going much lower than it currently is due to his HVF theory. Are you familiar with this Hunt volatility funnel?
Yes, having spoken to Francis on a weekly basis for the last, I think, 2 or 3 years, I'm fully familiar with it.
Familiar.
I may be more familiar with it than he is.
What's Wayne saying? What's your prediction about Deutsche Bank, and do you think a bailout may have to happen in the future?
Yeah, well, I think that there has to be that. I mean, the problem. I mean, the problem that the Bears have had here is that they've always they forget that we're in a zero interest rate environment. So you can, in theory, have a debt pile up to the sky, but be able to afford it because the cost of financing it is next to nothing, or in many cases nothing. So all it requires is for the ECB or the Bundesbank or whatever it is just to keep writing checks. It's very, very simple. This is really so. Deutsche Bank is going to stay there, like RBS is still there. You have a zombie. You have the zombie bank or zombie organisations, but just go on and on and on. So I wouldn't. It's not something I would bet against. It's not something I would bet against. But the problem is, all of this has destroyed the normal workings of the free market because you don't have boom and bust and winners and losers. You just have winners and then companies which just go into a state of suspended animation.
What about
it's like,
yeah? What about the mining sector? We've heard some echoes of optimism on the mining sector over the week. Do you have any thoughts?
Yes, I was going to talk. I wanted to talk about that. I mean,
Right.
the main thing was gold. I mean, the gold holding 1250, which was my call early in the week. Obviously, it wasn't a very intellectual call, because you can see that the low in June was 1250. So we just basically bounced off that. We bounced off the 200-day moving average, which is at 1259. So on that basis, we're really looking for mining stocks of all shapes and sizes. So the trend line is like that for gold. So hopefully it will remain within this rising trend channel heading towards 14. So this looks like, I mean, in fact, the only thing that worried me today was that I just read now that Goldman Sachs is saying that you should buy gold under 1250, which tends to be the kiss of death, especially with its calls on gold, but calls on oil, crude oil. But at the moment, 1250 is held. We've got a decent line of support there from February running through that level, and then everything else really stems from that. For instance, Randgold Resources, I think it's been down about 10% over the last week. It's found support above its 200-day moving average, 67.55. So while we're above that, I would be looking for a rebound back towards the 50-day moving average at 79 pounds and a penny. That's which I think would be a reasonable return from. It's a reasonable trade, I think, to buy into.
Great.
Just one. I think there was just a couple of other. I think I just wanted to look at Hochschild just quickly, which is a second line miner. Here we got this. I mean, in a way, this is an easier play because you've got that multiple support there. Old resistance become new support at 250. So above 250, back up to the highs at 300 pence plus. So people don't like the rocky ride of Randgold. They would choose Hochschild mining instead.
Great. Just go back to EasyJet. You mentioned we looked at EasyJet. Andy's come back to do you think it's going to just keep falling?
Well, I think the problem is it's become a proxy for. Sorry, I'm looking at the wrong market. I want to look at that actually. It's become a proxy for sterling falling. So that's going to make it very difficult to get out of this situation. Plus, you've had other factors there with terrorism and other things hurting EasyJet too. I think the only way that this is going to be transformed is if there is a sharp and a lasting rebound back above, let's say 130 on sterling dollar, or back below, let's say 87 pence on euro sterling. So I think there's quite a long way to go. But the problem here is that it seems as though the fall has been literally waiting in the wings for quite some time. And the shares topped out as long ago as last autumn. So it's like an oil tanker turnaround. Looks like a deep-seated problem. I mean, they had many good years, and it looks as though there's probably too much capacity in that sector now.
A lot of good work by I think Caroline McCall that's at the head. Done a lot of good work, and it was interesting to see how these top-down factors can really put pressure on the share prices.
I think it's actually rather sad that EasyJet were warning against a Brexit vote, and in fact all the horrors that the Project Fear actually worked. actually happened to them rather than for everybody in general.
Yes, well, so far, so far.
So
Um,
far,
um, does anybody else have any particular stocks that they'd like Zach to analyze? Anything else that's been catching your
yes,
eye
no,
this week?
actually, no, the other thing in the week, actually, I did want to talk about was just the fracking plays. Because that was probably the big move of this week was in that area. So I think Ithaca Energy is a stock that is worth looking at. I think the market anticipated the government intervening really there to get the shale gas revolution underway. And I think what's interesting here is that even though the shares have already got, well, they went down because the market gave up hope. But if you look and see where they came from before, they were at 150 before, when it looked as though everything was going to happen. And they're still only at 80p, even though we've got the green light. So that, for me, shows that there could be an opportunity there for the shares to go back to where they came from.
I know it's not going to happen in Scotland though. The SNP have put the kibosh on it in Scotland, unfortunately. So that's
Well, yes. Well, obviously they don't need the money.
no. Who needs another 9 billion in revenue? Oh, that's interesting. What
So
about?
there we are. But that might be worth watching. Also, Egdon Resources is another fracking play, and that's bounced quite nicely as well. Again, you can see that it was at 30p before the, let's say, the disappointment of the fracking not going ahead. So I think it'll be interesting to see. I mean, if you're into the smaller area of the market, that the fracking plays now should be very much in focus.
Very much so. ITV is being requested, and the Bank of Ireland.
Yeah, ITV. I think it's rather. It seems to be rather strange to me. I think that I'm not quite sure why it's so weak. I presume it's just on the advertising revenue, but it might be some sort of structural thing whereby terrestrial broadcasters are finally getting hit by the Netflix and the other new developments that you have, and that may be an issue now for for companies like ITV. So it looks ominously bad. And it looks as though it's heading, really back towards, to retesting the worst levels of the year. So 145, 150 on on those trend lines, on the lower trend line there. So below 190, it does look very, very, very weak indeed. But again, this is an oil tanker turnaround. It's not something which has just turned around and had a quick dip. You can see there's just an arc of gradually peaking and then falling below the 200-day moving average, dead cross with the 50-day and 200-day moving average. So this is a long-term sell.
Mm-hmm. Okay. X Factor alone, not enough.
No.
They run the channel on.
So, right. So there was just one company which I just wanted to finish on, which was it's oil services group, Enquest, where I just like this. Looks like a slow turnaround to the upside, let's say, where you had the breakthrough the 200-day moving average in April, bounced off it once and then twice and then back up again now, and I just think that this looks as though it'll head towards from 28p now up to 45. Maybe see it break 30 pence before going long, but it does look like quite a strong play at the moment.
Fantastic. Have you got time to look at the Bank of Ireland, please, and Tarsus Group?
Bank of Ireland, well, basically the gap down again. This comes into my type of the description of a long-term turnaround, negative turnaround here. You can see the way the shares double top last year and have consistently fallen since the gap down in June. So I would say they're probably heading back towards 0.15. The earliest you'd be thinking about buying into this probably is a back above the 200-day moving average at 0.24. So at the moment, just a very a slow sweep to the downside. And I think the other one was Tarsius, or I think that's TRS.
Tarsus, TRS, yes.
Right. This is an optimistic-looking chart, I would say. Basically, it looks like we've got an opportunity here at current levels to go long. Rising trend channel from June last year for the channel towards the 200-day moving average of 252, and a target up at 300 pence. So relatively straightforward, we hope, for a small cap situation.
And just finally, Carver is asking, what are the sectors, pulling back a little bit, what sectors are looking most exciting to you at the moment?
Well, I think I've probably just got to go with the energy at the now, because I think it's the oil and gas area. There tends to be, I mean, right from the blue chips downwards, there tends to be a reasonable choice of things to go for. Tullow's it looks like it's going to have a good run. Premier Oil looks like it's going to keep on trucking as well. You can see this chart here. Sideways consolidation, a break of 80 this time, should be very positive indeed. So you've got a lot of plays in there, and I think that's probably the place to go. Even if we only get up to $55 or $60 a barrel, I think you'll have the oil and gas sector bouncing quite well, and it's probably less economically cyclical and less vulnerable to the pound and other variables and the presidential elections than stuff in the real economy, let's say.
Fantastic. Zach, I think we're going to let you go. I know we only asked you to give us 20 minutes, which has been superb. Just quickly, you're going to be at the show next Friday. Are you going to be doing a talk or any seminar?
No, I was. That's why I suggested I'd just be at the bar, which I think is probably the best place for me, given my speech.
We can hold that.
But no, I always enjoy meeting your sister. She's a wonderful woman, and so I will go to attend.
I'll pass that on. I'm just putting a code in the box. Anybody that does also want to come to the show next Friday, there we are. If you use
I don't have a ticket. Will they let me in?
I'm sure they'll let you in. Or there we are. I've just posted a code. You just use code RTC 2016.
Right.
We'll stop you at the door. Well,
They're going to take it. Yeah, they let me in, and they might not let me in. Well, they might throw me out. But anyway, no, I've been to I think every London Investor Show in the recent past, so I don't want to miss out on this one.
Well, she's changed venue this year. It's at the Royal Horticultural Halls. So don't make your way over to Olympia, because it's not there. It's at the Royal Horticultural Halls. So a new venue for this year. So I think
Thank you, Simon.
Probably closer to you. Thank you, Zach. It's always great to have you on. Really appreciate you coming in, joining us. Thank you. I will take the presenter role back, and that actually concludes our presentations for this week, this London Investment Week event that we've had. So slightly quieter today on terms of the amount of webinars, but across the whole week, I'm sure you've had a enjoyable time, and it's been great to have your support. I've enjoyed presenting all these events as we do. Of course, interesting events coming up with a couple of live events in London, and also the Round the Clock Trader webinar, which will be back on the 27th of October. And I can't tell you that I've arranged for one or two new speakers to take part in that event on the 27th, and one of them, Alan Collins, very much a sort of technical analysis based a research consultant. He'll be talking, and someone from Metastock will be joining us. So all sorts of new things to look forward to for that. But of course, as always, we'll keep you in touch via email. And yes, Gordon, good point. YouTube is where we are hosting the recordings of the last few days, and I think we're just in the middle of uploading the recordings from yesterday's sessions. Day 1, 2, and 3 are already there for you. So if you want to head over to YouTube, I'll put that address again in the chat box. YouTube dash IX Investor. IX Investor is a hangover from the annual shows that I used to organise in London myself. The IX Investor shows, I'm sure one or two of you used to come along to them. So thank you for everything from me. I'm going to sign off now, and we'll look forward to getting together again soon. So thanks again, and have a lovely weekend. Bye-bye for now.